Good morning. I'm John Ellsworth, founder of Success Strategies Incorporated and the creator of the Success Strategies Advantage. And I want to welcome you to today's presentation, which I've entitled Tripwire: What to Do When the Bank Says Sell. Well, I think the first step in any of these kind of scenarios is step number one is listen closely. Why would you do that, you might ask? Well, I think the best reason to do that is, first of all, they may be correct. But I will caution you that many times I've found banks to be off track in their evaluation, in their analysis of a business and its chances for success. I entitled this process of theirs as Often Mistaken, Never in Doubt. But in the last 24 months, I've proved them wrong 3 times. 2 different banks I've proved wrong 3 times in 24 months. That's a pretty solid reason to take a closer look at your scenario if you're having some problems. So first of all, I'd say listen to their concerns, and then let's consider all the alternatives. Number one, can we turn this business around? I think that's a valid question that needs to be answered by the bank, of course, and by you as a borrower and the operator of the business. Can you indeed turn this business around? Along that same line, is it bankable? In terms of loan to value, acceptable standards for a lending institution, and in terms of positive cash flow going forward, is it bankable? Is it something the bank can depend on things turning around and moving forward? Because if not, there's no reason to pursue it, of course. In that case, they would be correct. However, oftentimes in the last 23 years, I've sort of felt like Mariano Rivera, who's the ace reliever closer for 17 years with the New York Yankees, coming in at the last second to save the game. So my advice on this point number one, can we turn this business around? Don't wait too long. Don't wait too long, because oftentimes it makes, the longer you put this off, this turnaround process off, the more difficult it becomes. And to the point of, you wait long enough, you can make it impossible. And I have seen a few of those too, unfortunately. Point number two, if the answer to number one, can we turn this business around, is yes, I think the natural next question is, what will it take? What will it take to get this thing turned around? And even further along that same line, can the bank help? If so, that's a win-win situation, because the last thing, contrary to popular opinion in the press, foreclosures are the last thing that banks want to do, because they don't help anyone. Maybe there's some legal fees that get reaped off of the deal, and I'm not belittling attorneys when I say that, but the reality is nobody wins. The borrower loses it all, typically, and the lender doesn't win anything either, because it's especially bad for the banks in 2 respects. Number one, it damages their reputation somewhat in the marketplace, and I assure you, they will not be made whole. They will lose some financial return as well. They will have some financial losses incurred. So before we go to there, let's go to number 3. Question number 3, can we change the business's debt structure? Now you say, well, what's that? It's like moving the chairs on the deck of the Titanic. And I would counter that, no, it's not. Changing short-term debt, some short-term debt into long-term debt, often, if we stay within the loan-to-value guidelines that are acceptable for the banking industry, it'll result in 2 things. Immediate improvement in the short-term cash flows at any given level of milk prices or whatever commodity you're marketing. And second of all, it'll lead to better long-term results, more positive long-term results. Here's a concept that you might want to consider also. I call this number 4. Can we trade assets? I go, I don't want to trade assets. Gosh, I barely can get by as it is. Hear me out, please. If we have room in your facility, and I'm referring to a dairy in particular, but it could work for other operations too. If you have adequate capacity or room in your facility, and it doesn't impact your labor too much, then I would consider, for example, sell 100 heifers at $70,000. buy 60 milk cows with the same money. Those 60 milk cows, if they make 75 pounds per day at 16.50, will yield gross income of about $271,000 a year. Take 60% conservatively off of that for feed, and you've netted out 108,000. But oh wait, there's something else. Remember we got rid of 100 heifers? That saves you $55,000 to $60,000 a year also, not having to feed them. And guess what? The net cash flow, positive 163 to 165,000 a year. Short-term cash flow improvement there again, and the loan to value didn't change. Because guess what? 100 heifers at $700 has the same value that went away, and the same value came into the herd with 60 additional cows at $1,200 bank values. So, and guess what? If you create a hole, you can buy heifers later. The important thing is they're still making them. Finally, are your costs per hundredweight in line if you're a dairy? If not, fix them. Remember, you've heard me say this many times. If you measure it, you can understand it. You understand it, you can control it. And if you can control it, you can improve it. And that's true with anything. I'll leave you with this final thought. Excuse me. From author and motivational speaker Les Brown, and I quote, "If you set goals and go after them with all the determination you can muster, your gifts will take you places that will amaze you." End of quote. I hope you've enjoyed this. Again, I'm John Ellsworth, founder of Success Strategies Incorporated and the creator of the Success Strategy Advantage. And I want to thank you for listening today.